Many consumers focus almost entirely on the monthly payment when looking at a loan. They ask whether they can afford an extra $200 per month, compare interest rates, and review basic loan terms. While those details matter, they often completely overlook the bigger financial picture. Before applying for any personal loan or financing product, you must first understand your existing debt obligations. This critical process begins by identifying every single monthly payment you currently make. Include your mortgage or rent, car payments, credit card minimum payments, student loans, existing personal loans, and any other recurring debt obligations. Once these numbers are listed, add them together to determine your total monthly debt obligations. Another important lesson is understanding that lenders evaluate risk entirely differently than borrowers. Borrowers often focus on what they can manage today. Lenders focus on whether additional debt creates future repayment risk. Another major issue is that many people underestimate their actual debt burden. Small monthly payments spread across multiple accounts may not feel overwhelming individually, but collectively they can consume an incredibly large percentage of income. Another critical lesson is understanding that debt exists to solve problems, not create them. A personal loan should structurally improve your financial position, simplify repayment, reduce interest costs, or create a meaningful, long-term benefit. It should never simply postpone a larger financial issue. Before considering any loan, the first step is creating a complete picture of your current debt situation. Without accurate numbers, every borrowing decision becomes dangerous guesswork. Financial success begins with understanding exactly where you stand today before making commitments that limit your tomorrow. The second step is calculating your debt-to-income ratio, commonly called your DTI. This is one of the most vital numbers lenders evaluate during the loan approval process. Yet millions of borrowers have no idea what theirs is. Your debt-to-income ratio measures how much of your monthly gross income is already legally committed to debt payments. To calculate it accurately, divide your total monthly debt payments by your gross monthly income and multiply by 100. For example, if your monthly debt payments total $2,000 and your gross monthly income is $6,000, your debt-to-income ratio would be approximately 33%. Another important lesson is understanding what these percentages mean for your daily life. Lower debt-to-income ratios generally indicate stronger financial flexibility. Higher ratios suggest increasing financial pressure and structural vulnerability. Many lenders prefer debt-to-income ratios below 40%, although modern requirements vary wildly. Another major principle is recognizing that lender approval does not automatically mean personal affordability. Some borrowers qualify for loans that place significant, crushing strain on their actual household budgets. Lenders evaluate baseline risk differently than individuals should evaluate long-term financial health. Another important lesson is that your personal comfort level matters far more than a bank algorithm. A loan that fits lender guidelines may still create unnecessary psychological stress if your cash flow is already tight. Another major issue is ignoring future economic uncertainty. Income can change. Unexpected expenses occur, and emergencies happen. A healthy financial plan always includes room for flexibility. The goal is never maximizing your borrowing capacity. The goal is maintaining financial stability after borrowing. Understanding your debt-to-income ratio provides an objective measurement of your financial position. The third step is evaluating the actual underlying purpose of the personal loan. Not all debt is created equally, and failing to recognize this distinction is a silent cash killer. Some loans structurally improve financial outcomes, while others simply move structural financial problems into the future. Another important lesson is understanding the difference between productive debt and reactive debt. Productive debt typically creates value, improves financial flexibility, or reduces overall costs. Examples may include debt consolidation and a significantly lower interest rate, or funding an opportunity that increases your income potential. Reactive debt, on the other hand, often covers ongoing overspending, recurring shortages, or lifestyle expenses that do not improve long-term financial health. Another major principle is calculating the total cost of the loan rather than the entry price. Many borrowers focus only on the monthly payment while ignoring the total interest paid over the life of the loan. A lower monthly payment may feel highly attractive, but extending repayment periods often increases total borrowing costs significantly. Another important lesson is understanding opportunity cost. Every future loan payment represents money completely unavailable for saving, investing, or building emergency reserves. Before borrowing, ask whether the loan creates a benefit that outweighs the future financial commitment. Another major issue is using debt to maintain unsustainable spending habits. Personal loans should support financial progress rather than mask underlying cash flow problems. The purpose of the loan often determines whether it becomes a helpful financial tool or a long-term burden. If you are borrowing to fix a consumption problem, the loan will only accelerate the financial damage. The fourth step is stress testing your budget against worst-case scenarios. Most borrowers calculate affordability based on ideal conditions where everything goes perfectly. Wealthy individuals and financially disciplined borrowers evaluate worst-case scenarios instead because they understand volatility. Another important lesson is asking difficult, uncomfortable questions before signing loan documents. What happens if your overtime disappears next month? What happens if an unexpected medical expense occurs? What happens if insurance premiums increase or baseline household expenses rise due to inflation? Another major principle is maintaining financial margin. Margin is the definitive difference between your income and your obligations. The larger your margin, the more flexibility you have when unexpected situations occur. Another important lesson is that financial stress often comes from a lack of flexibility rather than a lack of income. A household earning a strong income can still experience significant stress if every dollar is already pre-assigned to past decisions. Another major issue is assuming current conditions will remain completely unchanged for years. Personal loans frequently last several years. During that extended period, expenses, employment situations, and financial priorities can change dramatically. Before borrowing, evaluate whether the payment remains manageable under less favorable circumstances. The goal is not proving that you can make the payment today while things are good. The goal is ensuring the payment remains manageable throughout the life of the loan. Financial stability requires preparing for structural uncertainty rather than assuming everything will proceed perfectly. If a minor income drop breaks your budget, you cannot afford the loan. The truth is that calculating your debt before applying for a personal loan may be the most important financial step you take during your entire life. Start by identifying every monthly debt payment. Calculate your debt-to-income ratio. Evaluate the purpose of the loan. Calculate the total borrowing cost. Stress test your budget against realistic future scenarios. Another important lesson is understanding that borrowing should fundamentally improve your financial position, not weaken it. A personal loan can be an effective tool when used strategically. It can reduce interest costs, simplify payments, and improve immediate cash flow. However, it can also create additional financial pressure if the numbers are not carefully evaluated first. Another major principle is making decisions based on cold facts rather than heightened emotions. Financial stress often leads people to seek quick solutions. Successful borrowers slow down, analyze the numbers, and make decisions based on long-term outcomes. Another critical lesson is that lenders determine whether you qualify, but you determine whether the loan makes sense. Those are two very different questions. Before signing any loan agreement, make sure the debt supports your future goals instead of limiting them. If you found this helpful, hit the like button, subscribe to the Daily Yield, and leave a comment below telling us whether you've ever used a personal loan to improve your finances. Because we're building real financial progress, one step at a time, protecting your cash from the silent killers that hold most people back. If you found this helpful, hit the like button, subscribe to the Daily Yield, and leave a comment below telling us whether you've ever used a personal loan to improve your finances. Because we're building real financial progress, one step at a time.